is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody. Hey, welcome back, Zinger Nation. Welcome to another episode of Benzinga Live. It's a Tuesday. You know what that means. It is time to bring on my man, Ryan Pannell from Kaiju Capital Management. Without further ado, let's bring my man Ryan on. Ryan, how are you doing today?
Good. How you doing, Aaron?
I am great. Had a good weekend coming into the new week. Looks like, markets had a good day yesterday, opened lower today, but as what happens oftentimes is the markets open lower, and then, I guess traders and investors on the street, on Wall Street, are like, hey, it's not too bad out there, man. Let's go. We can buy some of these stocks, and then they go up throughout the day. I don't why. I guess can we just start there? Why does that happen? It seems like so often.
Depends on the day, man. It just depends on the day. News cycles, reporting, beginning of earnings, etc. Like yesterday, a good start to the season. Like we saw good flows and printed up heavy, and today a little of that shed off. So way it goes.
Got it. So let's get over to Kaiju. We've been lucky enough, Ryan, to have you on now for a number of weeks, learn more about the company. I think I don't want to get this wrong, but I remember a while ago, this was like 2 months ago now, we talked about the actual Kaiju, the name itself, like it was like a mythical monster almost. I think like some sort of Japanese mythical creature, but I'm picturing now like a type of creature with different arms. And what about Kaiju's the company, the different arms of the company? You have the Kaiju IP, Kaiju ETF advisors. We talk about DIP a lot. Kaiju Capital Management. How do all these different arms work together? And can you describe kind of these different verticals for our audience?
Sure, and it's a good question. I mean, we've got I think there's 3 or 4 websites, and they're all coming together in Q4 here under a rebranding exercise. It'll have them all consolidated at kaiju.ai, and it'll be a lot clearer in terms of what we do and how they interact. But the short version is everything we do starts with Kaiju IP. So we develop AI curated and directed trading strategies. Kaiju IP is where all of our data scientists, AI experts, all of the different scientists that work here work at Kaiju IP alongside our dev and tech team. And we start by examining strategies that we've used on the private fund side for a while manually. We validate that there's significant enough edge there to exploit, and then we develop that into an AI curated and directed strategy. And from there, we sort of ask ourselves a couple questions. One, can it be made 40 Act compliant so we can push it out as an ETF, offer it to a broader investment base? If the answer to that is yes, then it heads over to Kaiju ETF Advisors and begins the journey that DIP went through before it launched on NYSE last December, coming up on a year now. If the answer is no, and unfortunately the answer is usually no, then it heads over to the private fund side. We apply it to one of the multiple funds that we manage, and that's driven by Kaiju Capital Management, which is the private fund manager, the fund manager side of the business. But really, when we're creating the IP at Kaiju IP, there is a synergy between Kaiju Capital Management and Kaiju IP. The traders are very involved because execution and management of positions in state is a big part of it, right? The AI will simply assume, by and large, they can just do whatever it wants to do, and that is not realistic. So traders weigh in on liquidity, et cetera. And we're always updating our liquidity engines anyway. So there's all of that, and then Kaiju Worldwide just owns everything. It's pretty simple actually when you kind of run through it like that. But yeah, if you don't have the picture, we need an org chart on
a tree, almost a family
tree. Yeah,
tree
something like that. Something like that.
Well, so Ryan, we've talked in the past about the DIP ETF, which is of course managed by Kaiju's proprietary AI, and we've talked about how DIP can learn and get better the longer that it operates. Are there other ways it improves? Are you making upgrades to the algorithm or hardware? Can you accelerate its learning process in any way?
Yeah, I mean, there is an autonomous learning component to DIP. So it does have the ability to alter its own code, specifically, as we've talked about before, how it weights different criteria that it uses to evaluate whether or not what it's observing is an authentic dip or something that's just a bit of extra noise. But independently on the human side, yeah, there's a team that's constantly trying to improve dip. Again, we're sort of limited by the 40 Act constraints on the fund. We can't just do whatever we want, but we always try to find additional efficiencies. And we did just recently, maybe 3 weeks ago now, roll out the very first DIP 1.1. So we did make some slight changes to the algorithm that should help it recover from downturns quicker than it has in the past. At least that's the intention. We'll see if whether or not that bears out. But yeah, always looking to improve and make it a better product for our investors for sure.
Got it. And then Ryan, so we have a new format coming to this show next week. So we teased it last week. We talked a little bit about it. We were talking a bit about it before we started today. I'm super stoked about it. I think it'll deliver kind of a more useful type of information and educational material for our audience. Can you talk about what this show is going to look like moving forward?
Yeah, well, we sort of had the idea of doing this limited 8-part series in between now and Christmas, and we'll just call it the Kaiju Educational Series. And it might be the whole thing might be useful to some of your viewers. Bits might be interesting to some of your viewers. Maybe just a couple points to more experienced traders that are watching your show. But the idea was to sort of walk through and establish the foundation that any retail trader should probably have before trying to wrestle with more advanced concepts and trading systems. And it does no good for me to come on here and babble about how to avoid like flow predation, which I've probably said on this show like 12 times by now. But I guess like 90% of the viewers have no idea what that is or why they should even care, without understanding those sort of fundamental concepts. We thought, okay, so here's a way that we can kind of give back to the trading community. A number of us, like myself, started off a long time ago as retail traders, and there was no information available. People just didn't share it. Professional traders just didn't want to talk to you, and so it's a way for us to create an informational base that I wished I had when I was a lot younger. So that we'll talk about trading education from like free all the way to some limited paid, where to find it. We'll talk about broker selection. We'll talk about trade system setup. We'll talk about indicators. We'll talk about risk management. We'll talk about news aggregation tools, obviously weaving AI through everything, as that's our area of expertise in all of this. Move through trade planning and execution, using some of those more complex orders that some of your viewers may have access to, like no idea what the hell, peg to last or sweep and post or stealth or whatever it is supposed to achieve. And when do I use that? Talk about routes. Are you just sending it out auto? Are you routing to Arca? Are you routing to SIBO? Are you routing to PhilX? Like, why would you choose any of these routes? And hopefully get to the end with having provided sort of a solid base where different traders can learn more from there on their own. Obviously, it's not supposed to be like a comprehensive course, just like here's what we would suggest that you would want to know at a minimum. This is why. Here's some information. Here's where you can go to find more. And then that lets us move into the new year with sort of a Kaiju professional series where we can talk a little more granularity in terms of portfolio management, holistic risk management, some more advanced concepts that are just going to just going to lose you if you don't have any of those basics or understand why we would recommend something that we might recommend as something you might consider. So I'm excited about it. I think it'll be fun, Aaron, to kick it back and forth. I'm counting on you to kind of challenge me and keep me on the straight and narrow with this new plan.
Oh, awesome. Well, I'll do my best there. And yeah, I mean that's why I'm excited too, Ryan. And one of the reasons I'm so excited is, we've talked about this before, but and you mentioned it just now. You used to be a retail trader, so you get it, and then now you're a professional trader. But for some reason, for retail traders, I mean, there's a lot of different hobbies out there. Like, I mean, if you were into like knitting, I don't think a lot of the advanced knitting stuff feels like it's like secret or that you can't get access to it. But for some reason in trading, the like high level stuff I think feels very out of reach and for a lot of retail investors and day traders. So I think for them to be able to come here, learn that information from someone like yourself that has the experience to be able to take that next step, I think is going to be a great thing. So I guess Ryan, can you speak a little bit about the difference in your time as a retail investor, and then I guess once you made that transition to professional trader, and kind of I mean, you were running a multi-million dollar fund. That's nothing to sneeze at.
Yeah, I mean, we're probably a little over half a billion in mixed assets now. And I started with a $15,000 home equity line of credit that my wife was nice enough to let me let me take out and open an account at Interactive Brokers like a million years ago. Um, I mean, some of it doesn't apply because it was just a different world back then, right? There was no Benzinga. Um, the only sort of holistic news aggregation that you could find in terms of terminal was Bloomberg, which like you couldn't possibly afford and was pointless anyway at that level. And so you're sort of scrounging around these bulletin boards originally, which it was really hard to tell who was real and who wasn't in those. And I don't mean because there were bots. It was, a hodgepodge of the blind leading the blind, but there was the odd ex pro trader that was active in those boards back then, guys that, like the SOS bandits from the late 80s, early 90s were active in that space. And some were kind, most were not, in terms of sharing information. And so and the internet was obviously different then as well. Like you're talking like 2000, 2002. You're like waiting for web pages to load, click, 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 click. And just a different world now. There are, for sure, I mean, the thing that excites me the most about the opportunity for retail traders today is that there are absolutely pro level tools for anybody. Like you do not need, I've said this before on the show, you do not need a Bloomberg terminal. In fact, you probably, like that's not even going to be useful to you because they're,
Benzinga Pro.
yeah, Benzinga Pro, right? I mean, Benzinga Pro is, this is self-serving. Oh, it's not self-serving. It's serving for you, man. I don't know why I'm saying it, but it's awesome. Like it's awesome. There are a ton of tools in there. The charting system is excellent. The events calendar is spot on. Like it aggregates really, really well. So like that's world-class technology. You've got, I can advocate for like Worden's TC2000. So even good old TWS Mosaic isn't terrible for speed entry, and Classic is fine for
Yeah,
holistic
you don't
portfolio
need the you
management.
don't
Like,
need the Bloomberg. It's like
no,
it's
you
like if you
don't.
it's like if you buy a, $250,000 car to drive a mile to your office every day. You
Exactly. You're
probably
just
didn't
commuting
need
in
you probably
traffic.
didn't
Like,
need that.
yeah, you probably didn't need that. And it's frankly, it's not even the $250,000 car. It's like it's designed to monitor multiple portfolios across multiple funds at the same time, which the average retail trader is not doing. So you don't need this thing. You get these world-class tools available at a very low price point. The one thing that's missing is that like in 20 years, that fundamental education hasn't really changed. Like there are more order types of greater complexity, but the ideology behind when you would use them and how is the same. Asymmetrical return on risk, trade planning, risk mitigation, it's the same. So, you can have access to all these tools is really exciting, but if you don't know what the hell you're doing with them, you're just going to make a bit of a mess. So I feel like with just a little bit of guidance and education, we get this whole cool generation of totally empowered, self-directed traders and investors, which I love. I mean, that's kind of not what we do, given that we we manage funds for people who are like way too busy to do it themselves. But I'm a huge believer in people being able to manage their own portfolios. I mean, if you're watching, better than I do, what your goals are and how to accomplish them. So it should be pretty cool. I think it'll be fun, Aaron.
I think it will be too, and I think not only will it be fun, obviously it'll be informative and hopefully educational. I think the goal should be that if you're an investor, a trader out there watching this show, listening, and you've dabbled, you've kind of started your journey, and you know that you've still got some improvement to go, you still want to learn some things, this will be the place to be on YouTube, and it's all going to be for free. So Ryan, can't thank you enough for this, because again, I mean, even me personally, like, I'm excited to see what I learn and take away from this, because I might know 80% of the things we talk about, but maybe not the last 20. And that might be the same camp that a lot of our audience is in as well. So even if you think, oh, yeah, I already know everything there is to know, if that's, how you feel right now, then maybe tune in anyway, just to see if you're wrong, and you get shocked, and now you know a few things, and then a few new things. Not the worst thing in the world.
I mean, always, like, everyone should always be trying to learn something. And we do that collaboratively here at Kaiju. Like, the guys who are working on our AR systems are by and large like PhD level guys from Zurich and Imperial College and like that caliber of institution, but they still have no idea what short interest is, or like where liquidity pockets can hurt you on a management decision intraday in an illiquid option spread, or what's going to happen when you try to buy in that spread under pressure and the market maker literally crushes you with the stock it's buying to hedge the risk you're offloading, and you get to watch in real time. You basically put the boots to yourself. Like, that's something that they learn from the traders. The traders learn from the data scientists. The dev team teaches the data scientists teach the dev. We are always learning at every level. And so, yeah, I mean, you've probably got viewers here that are quite handily managing their own accounts and like, yeah, I don't really need most of this information, but maybe there's something there. How to set a bracket order for any price of underlying that they don't use. They enter on a limit order, and like getting burned on execution, thousands of trades over time equals a lot of money. So this is why we really like our executing traders. This is why like pennies matter. And we can help you learn some mechanisms to refine some of these systems that you're already familiar with. So I hope there's something there for everybody. That's the
Yeah,
intention, at
I
least.
always I always think about it with kind of like a golf analogy with like, if you picture Tiger Woods, right? Maybe not Tiger now, but like back in his
I knew you were going
prime,
to
or
work golf into this, Aaron. Like, you just
I
had to,
know,
like, you're going to find a way to work golf into
once an
this.
episode at
It's an
least.
episode.
But it's like even Tiger Woods, when he was on the top of the game, it's not like he woke up and didn't practice or didn't try to get better, even though he was already the best in the world and beating everyone. It's like, okay, well, your chipping still might need some work, or putting. There's always something, and like trading, investing, there's no different. You might be, doing well, but that doesn't mean there are certain areas that you can't improve on or can't work on.
Yeah, absolutely. And we look at like how we create our engines, the technology, foundational platform technology that we use. I mean, once we've launched the strategy, it takes so much effort and energy and time. There's this sort of natural period where everyone just kind of walks away for a little bit. And it's like, okay, that's working. Great. I don't have to look at that for like another 6 weeks, 2 months, half a year, whatever. And it never fails. A few weeks go by, the buzz quiets down, the strategy's humming away, doing what it's supposed to do. And somebody, one of us, will circle back around to it and just start poking at it with a stick. It's like, you know, I've noticed that this always executes slightly on the high side for no particular reason. Let me dig back through this a little bit. And there's just like tweak, 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 tweak. Sometimes it doesn't do anything. Sometimes it does a lot of good. Sometimes the things that you think are going to do a lot of good, cause a lot of harm. I mean, that is inevitably the case with aggressive risk management, right? Whenever we apply, we have the ARC, our AI risk containment system, and when we apply that to a strategy, like it is always going to take the P&L down, but it'll reduce volatility by 80%. So you're like, okay, what do you want out of this? If it's just gross P&L, then leave the ARC off and let the thing run. But if you want to explain cavitation to your fund holders and you want to ease their fears in the times of turbulent markets, yeah, then you flip it on. You're going to make 5% less and you're going to reduce their volatility. So, there's always something to refine. And I'm sure your viewers are no different. They're always looking for a little extra edge. Who isn't, right? Golf swing or not.
Exactly. Always get that edge where you can, and that is why we will be debuting the new show next week. So you guys must come back to tune in if you again are trying to take your trading to the next level. Ryan, I'm super excited about it. Again, next Tuesday, be there, be square, 11 a.m. You guys know where to go. It's just YouTube, Benzinga. Pretty simple. You guys are here now. So if you're here now, then you can probably find it again next week. So again, 11 a.m. We'll be back, Ryan. Thank you for hopping on today. Anything else you'd like to say before we come back next week?
No, I think we've wrapped it all up nicely. I don't want to bore people to death. Just leave everybody with keep an open mind. And we don't really have anything to sell you when it comes to these best practices. So, evaluate them as you see fit. Maybe it gets you thinking, and I hope it's of benefit to everybody.
100%. Well, all right, Ryan, I'll let you go. Enjoy the rest of your Tuesday. We'll be
You
back
too.
next Tuesday. Yeah, take care. We'll talk soon.
Cheers.
All right, guys, that was Ryan Pannell from Kaiju Capital Management. Again, the DIP ETF ticker DIP. Gonna go ahead and drop that in the chat as well as a link to the website if you want to learn more. But again, next week we'll be starting our new educational series. Basically, week by week, we'll pick a different topic in the trading and investing world, break it down. Again, Ryan has years and years experience managing money on the professional side, so he can kind of give us insights as a retail investor and also a professional trader. So kind of, both sides of the spectrum, both sides of the coin, however you want to, say that. But you guys get the point. Let's go ahead and pull up our Benzinga Pro. We mentioned it with Ryan, kind of our version of a Bloomberg terminal, and go through some of the top headlines of the day. Pull up our news feed here. Let's start with details. Let's see. So I mentioned earlier, SPY, everything opened lower today. S&P 500, the Dow Industrial Average, the NASDAQ Composite, everything opened lower, and everything so far has been coming back. If we go to a 2-minute chart, you can see here, basically, I mean, you had a little bit of chop right at the open here. You can see where my cursor is, opened at 9:30. Market moved slightly higher, took a big dip, and then just a big green candle here. And these are 2-minute candles. So you can see within like 5-6 minutes, the S&P or the SPY ETF went from 432.83 to 434. So almost $2 on the SPY in the matter of like 6 minutes, and then, continued moving higher. So a pretty violent move to the upside there. You can see we're basically, since we opened lower, basically just to where we were at yesterday in the SPY right now. Going over to the Q, seeing how technology is today, a little bit, lower. You can see from yesterday, Dow Industrial Average, DIA, we are pretty even, pretty flat here. XLF. Financials in the green, up 0.3%. You had Bank of America report earnings this morning. Actually, surprise beat. We'll go over to Bank of America's stock right now. You can see trading higher by about 1.5%. Even with the beat, though, I mean, look at Bank of America's stock on the daily chart. This thing has just been ugly, getting beaten up by. I mean, we are lower than we were pre-COVID. Pre-COVID, before the stock market crashed with COVID, Bank of America stock was trading at $35. Now we're at 27. So, I mean, I guess like it's just hard to imagine from I mean, the economy has grown since the beginning of COVID. I mean, it shrunk briefly and then grew, has overall grown. Like, I think GDP is higher than it was, and it's good. GDP is going to be, I mean, let's see. Let's go. Uh, GDP by year, macro trends. This seems pretty reasonable. All right, yeah. So I mean, our GDP is here in what 2022. Here's where it was before. It's just hard to imagine. Basically, my point is that the overall economy has grown. If the United States GDP has grown the past 3 years, and Bank of America is one of the biggest banks in the country, how is it not growing with it, right? Shouldn't it be managing more money? I mean, I guess the outlook isn't as good for a bank right now with higher interest rates. But then again, like Bank of America is part of the reason it beat earnings today was because it's making more money than it had anticipated on higher interest rates. And so, you had what happened with Silicon Valley Bank earlier this year, back in March, was essentially that the bank was buying these treasuries when rates were really low. As rates started going higher, those bonds and treasuries that the bank were holding, the value in them went lower, creating a hole in the balance sheet. Now, if you're a bank like Bank of America, that's not going to be as big of an issue for you for a few different reasons. A, Silicon Valley Bank's its depositors, its customers were all very, very much in the same type of company group. There were all these high growth tech companies out in Silicon Valley, startups type of things that were basically like, hey, we're running an app to do dog walking and delivering dog treats to your door. And it's like, okay, so all these companies were super high tech, high growth. Once interest rates started to rise, those companies had more of a problem raising money. Well, why does that matter? Because then the companies needed to start dipping into their savings to do things like pay their bills, pay their employees, etc. When all those companies started doing that at the same time, it became a problem for Silicon Valley Bank. Bank of America doesn't have that issue because it has a more diverse customer base. It's not just high growth tech companies. It's all types of companies, it's all types of individuals, all types of families. So the chances are is that not everyone's going to be rushing to get their money out at the same time. The other thing is that the Bank of America, because it's so much of a bigger bank and holds, a lot more assets than a regional bank like Silicon Valley Bank, can actually afford to, in a duration matter, hold these bonds to maturity. So if it doesn't, if things aren't looking good, it's not like it has to sell its 10-year bonds or 20-year bonds for a lease. If Bank of America needs to, it can hold on to those bonds till maturity. Is it ideal? No, of course not. A bank like any, would rather have more liquidity, whatever. But so I don't think Bank of America is really at the mercy of a lot of things. Maybe it's exposed to a lot of the same problems as Silicon Valley Bank, but probably not the same. I mean, look at this. This is in 2018, February 2018. Bank of America was trading at $33. Now it's at 27.5 after an earnings beat. So we're like significantly lower than we were 5 years ago. More than 5 years ago on this stock. I mean, that's April. This is October. It's 5.5 years. That's a long time. 5.5 years is a long time. Alrighty, y'all. Wait, hold on. I saw some people asking about some stocks in the chat. Target, IWM. Have I bought some Rivian? No, I have not yet. I'm trying to. I'm in the process of it. I'm freeing up some capital to buy Rivian right now. Have I missed? Let's see have I screwed up or done well by not buying it. Looks like I've done kind of well by. I mean, I think this is just a long term. You could tell me that this thing's gonna go down 50% in the next 6 months, and I'd say, hey, I'm not surprised. So like I'll probably just buy, a couple $100 here, a couple $100 there, a couple $100 here. Hopefully eventually I have, 1,000 or so shares, what would that be? Uh, 1978. Actually, no, that's $20,000. Hopefully, I have like 100 or so shares at some point. Yeah, like 2,000, a few $1,000s worth of Rivian shares, just so that in the off chance it does, have Tesla type growth someday, you really have those like exponential returns. At the end of the day, and I'm a big, 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 big proponent in investing just in the broad market. When I get paid every 2 weeks, I say this all the time on the show. When I get paid every 2 weeks, a portion of my paycheck goes just into the S&P 500. It's just very mindless. It's boring, but it makes me money and it's going to make me a lot of money throughout time. One of the ways to really, really build like wealth in the stock market is to have high conviction picks in smaller companies and start growing a position over time and hopefully being right on it. Do a lot of people try to do this and get them wrong? Yes. Do most people that try to do this probably get them wrong and not get their 10 bagger or 100 bagger? Yes, of course. But for every 1 in 100, 1 in 1,000, 1 in 1,000,000 companies, you have your Apples, you have your Teslas. So if for whatever reason, and I'm not saying that's my Rivian. I honestly haven't even really looked into Rivian too much myself. I've just been seeing more and more of them. I think their cars are cool. I think the market's big enough, or I think the industry of electric vehicles is big enough that Tesla's not going to be the only player out there. And it seems like Rivian, at least from what I've seen, has enough sauce to stay, if you want to say that. It's not like I think gonna like be out of business in 10 years, and I could be completely wrong on that. But whether it's Rivian or whether it's some other smaller company, I am looking for that, for a company that I can have high conviction. And I'm not talking about, oh, I'm going to put my entire life savings into it. No, I'll be smart about it. But I'm talking about building, like putting thousands of dollars of what I make a year into a company that I believe in over time. And if I'm right, could lead to, again, like, I'm not saying going to make me a billionaire, but lead to good money for me versus buying just the S&P 500. So I'm out on the hunt for that type of company. Again, I'm not going to be Rivian. I'm not saying that's Rivian for me. It could be Rivian. I don't know. You like Unity and Enphase also, Caleb? I had 100 sold out, which was a good short-term move, but I should have just held. Yeah, VU is the same as the S&P 500. It's best to buy VU over the SPY ETF because the VU Vanguard I think just has lower expense fees. I actually through my like work 401k though, I don't think VU's an option on there. I think it's the Fidelity 500 whatever the Fidelity one for the S&P 500 is. FXAIX I think is the I don't know. Either way. Um Yeah, if you were just doing it on your own, like through Robinhood or something, then VU is your way to go. Damn, son, look at Spy, baby. Holy shit, these are one of those days that you could have just bought calls off the rip, bought calls right off the open, and just sat back and frickin' cashed. I mean, this thing is ripped $5 damn near intraday now. I mean, this has been an incredible move on the Spy. We'll have to keep watching this, see if it keeps ripping. I saw some other stocks in the chat. Target. Target's a buy to me. I mean, look, you're still getting it at this huge, huge discount. Why am I? What am I touching? Touching something that's putting a lot of black stuff on my hands. I don't know if it's a microphone, my computer, what it is. This thing, something. Target to me is a buy. I mean, looking at it on the daily chart, this thing ain't going anywhere. Target's a buy to me. I honestly, like, just don't really know what else to say about it. Like, I don't think it's, like, the most exciting investment in the world. Do I think it comes back from here a little bit? Yes, I do. Do I think it gets back to 280 anytime soon? Probably not. But yeah, I mean, I think you have a lot of different catalysts, holiday shopping coming up, all these different things. I think what you're going to see from Target and a lot of other major retailers is that things are just going to end up holding up better than a lot of people, expect. Is 3M a buy right now? Yeah, I think 3M got rid of some of its there's been a lot of concerns with this company about lawsuits. There was a big one with its earplugs leading to like deafness and problems in a lot of soldiers and veterans and stuff like that. And so big, huge multi-million billion dollar lawsuits hanging over the company's head. I'm pretty sure it's resolved some of them. I honestly like we got to have an analyst on or something that can, because it's 3M is one of those companies that I think in theory is supposed to be these super steady kind of stodgy companies. Like they're staples, they produce like tape and things like that people just need to buy, hardware, construction things. But I think maybe like what you're seeing is some of these brands are just being undercut by like why not buy an off-brand type of something from China that's coming from, like, if 3M, and I don't know too much about this, but I'm just gonna make this up. But if 3M is getting their tape or whatever made in China and then bringing it over here and putting an American company's label on it, why not just buy the whatever straight from the manufacturer? It's like it seems like a lot of these kind of staple brands are struggling, and I wonder why that is. But I wouldn't be surprised if it's because people are kind of going direct to the supplier and just buying stuff off brand because they know it's coming from the same place, essentially. Building a position in MM, and I don't hate that because it pays a good dividend. And I mean, not much else to say about 3M. I think that's why the stock's been beaten up so much again, even recently, is because of these lawsuits. But if it can get rid of that, then you have the good dividend and could also get a nice bounce back. KSS, Cole's up 7%. What's going on here? Cole's pretty beaten up too. IWM. I do think as we enter a new kind of, I don't want to say bull market, but I do think we're due for a nice little rally here on small caps. And I think whenever we do enter the next bull market and we're really ripping again, I think you'll see small caps be a leader. And it's been a while since we've been able to say that, but I think small caps are coming back in a big way. Alrighty, y'all. We're gonna go ahead and wrap up the show today. Again, next Tuesday. Make sure to stick in for the or come back, tune in for the new Kaiju educational series. We will be having some content later in the day. I believe swing trading with Money Mitch, as well as Cannabis Insider coming up at 1 p.m. So, alrighty, y'all. Make sure to stay tuned for that. Again, we'll be back Thursday as well. Till then, stay green. Happy trading. Peace and love, y'all.